Hello everyone and a very good afternoon to all. I am Dinesh Sharma and on behalf of Care Ratings welcome you to our live webinar on Real Estate Regulation Act 2016, Structural Changes in Real Estate Industry Credit Dynamics. Care Rating sincerely appreciate your time in joining us for this webinar. We apologize that Ms. Jyotsna Gadgil could not be joining us because of health issue. To take you further on this, may I introduce our speaker for you today, Ms. Jasmeen Kaur. Jasmeen, who is also based out of our Delhi office, is working with Care Ratings as Deputy General Manager. She has an experience of over 12 years with about 10 years with Care and has been a part of the ratings team working across various sectors like real estate, infrastructure, financial sector, paper industry, etc. Mr. Ashish Nainan joining us from Bombay office. Ashish, who is working as a research analyst, is a part of our industry research team. The webinar discussion is in the form of a presentation which is visible on your screen. In case of queries, please key in your questions in the slot provided. We would take the question and answer session at the end of the presentation. May I request Ms. Jasmeen Kaur to begin the session, please?
Thank you, Dinesh. Good afternoon, everybody. Today, we are talking about the Real Estate Regulation Act and the structural changes that it would bring about in the real estate industry with specific focus on credit dynamics. So the agenda for the discussion today is going to be that first we will touch upon the issues in the sector and why a need for such a regulation has arisen. What are the salient features of the Act? A brief on the state-specific features. And finally, what it means for the developers and consumers and the impact on the sector with a credit risk perspective. The issues in the sector from a credit viewpoint have been many. The sector has been impacted by many issues in the past. Firstly, we'll talk about the project execution delays. The reason for delays in projects in real estate sector are many. There are issues of diversion of funds into other uses. There's a lack of capital or funding for projects. There is lack of approvals or slow receipt of approvals that lead to projects being delayed. Unclear land titles which lead to disputes and therefore stuck projects. There are regulatory hurdles like environmental concerns, NGT bans, etc. Delay in infrastructure development around the project site which leads to delays and poor project management. So from a credit standpoint, obviously, project delays are an issue. Diversion of funds in the sector has been rampant. It leads to cash flow mismatches. There is routing of funds from one balance sheet to the other, we know that. The project funds are used for land aggregation. They are parked in illiquid sources. The funds get diverted to other ongoing projects or invested in group concerns, etc. These kind of practices lead to cash flow mismatches. There's a high indebtedness of developers. What we have seen over the last 3 to 4 years in the sector because of slow sales and aggressive development which is already undertaken by the developers, the level of debt in the balance sheets is fairly high. This has led to low credit ratings and even rating downgrades. There are slow sales and lack of consumer confidence in the sector. Lack of consumer confidence is because of low transparency. There is a poor corporate governance. There's no transparency in financial statements and developer operations. These have been issues in the sector. The sector has been unregulated and largely fragmented. The lack of transparency is on account of both the developer operations, the track record of the developer, as well as information about the project in which the buyer wants to invest. And obviously buyer has always had very little recourse. Now, RERA addresses many of the above concerns. The main objective of RERA is to bring about transparency in the sector, to protect buyer interests, and penalizing the wrongdoings of developers. A lot of malpractices in the sector, concerns over transparency, concerns over buyers, the issues over project delays without adequately getting compensated. All of these are going to largely get addressed by RERA. Now, we will be briefly touching upon the salient features of RERA, and then we will go on to talk about its implications from a credit standpoint. What implications so far as the rating agencies are concerned and so far as the lenders and financiers of the projects are concerned is what we will then emphasize on. My colleague Ashish Nainan from Mumbai, he will take forward from here and talk about the salient features of RERA. Over to you, Ashish.
Thank you, Jasmeen. Good afternoon, everyone. This is Ashish Nainan from the Mumbai office. We would be briefly touching upon the salient features of RERA 2016. And we would be also looking at why RERA has been brought in place. RERA has been brought in this sector called real estate to primarily regulate this industry. Now, if we look at real estate as an industry, it is a mix of organized and unorganized developers. So, and it is very highly scattered with quite a large number of players in each region with a few strong regional players. Now, RERA 2016 intends to ensure transparency in the industry as a primary pillar. Secondly, it wants to bring in some kind of accountability from all the stakeholders, which is very important. And this is how the Act wishes to bring in the whole stability. Now, if you look at RERA as a regulatory authority would act as an umbrella body, which would ensure a single window to administer and address all the compliance and disclosure related processes. So this way it becomes very easy for the developers. Now, if I'm to talk about the salient features of RERA 2016, we would look at they would primarily look at protecting the consumer interest. That would primarily entail timely delivery of projects, financial safeguard for the buyers, and talking about the financial safeguards. So safeguarding financials for buyers. How is RERA looking at safeguarding financials of buyers? So what RERA 2016 has done is it has made it mandatory for developers to deposit 70% of the amount realized from allottees to cover the cost of construction and the land cost. Now, it not only includes this, it also makes it withdrawal in proportion of completion of the projects. So what this would ensure is something called diversion of funds by developers in order to project funds for land aggregation, and funds diverted to other ongoing projects would be thwarted. So this is how RERA looks to financially safeguard buyers and institutions who are funding these projects. Secondly, it would be mandatory for every real estate project developer and as well as real estate agents to register themselves on the RERA website. So RERA website is a framework wherein the state which is responsible for implementing RERA authority in their state would come up with a website, and each and every real estate agent as well as the developer has to register there. So it would become mandatory for these real estate developers and agents to register themselves, and all the details of the projects would be freely accessible from the website. So this makes it very easy for buyers and the financial institute to actually access information related to the projects. The third most important thing would be timely completion of projects. Now, if we look at it, one of the biggest pain points in the sector has been delay in projects, which leads to huge issues for the buyers, and developers normally sway away from the whole issue. So what RERA wants to do is it has brought in a very good framework where it would be penalizing the developers for delay in any kind of projects, but it is not one-sided. It would also ensure that the buyer pays in time, otherwise he would also be penalized for the developer. The fourth important salient feature that we can see would be approval from allottees before any kind of changes in the structural plan or shareholding. Now, through this, RERA looks to strengthen the corporate governance part. Because if the promoter wants to divest or wants to leave the project in the middle of the construction, he has to take actually 2/3 of the allottees approval before any kind of change is made in the shareholding of the company which is developing the project. Or even if it wants to make a structural change in the project, it has to take a 2/3 approval from all the allottees or the buyers. Fifth and most important part has been on the quality side of construction. So now there is a liability on the builder for the quality of construction or the structural build of has to ensure that for the next 5 years, since the project has been allotted to the allottees, without charging any additional cost, the developer would have to rectify or repair for any structural or quality issue in the development. So now real estate would actually be regulated in the way that the buyer has certain kind of safeguards, which would ensure not just him financially or in terms of just as a consumer, but as well as a user of the development. The sixth and would be specific punishment and penalties for pertaining to non-compliance by developers, because like we said, if you look at timely completion or any kind of financial malpractices, till now there were no specific rules or penalties or prosecution rules for developers. Now what RERA intends to do is bring in any even small non-compliance by the developer. So all in all, what RERA wishes to do with parent, making all accountable in the same process, protect. We would be discussing about the state-wise implementation of RERA. So as we all know that and it has been introduced in the year 2017 from May 1st. But each state has to come up with its own regulatory authority. Now, the reason for this being that land being a state subject, the states have to administer the framework that each of its own regulatory authority, which would be registering real estate projects as well as the real estate agents. Appellate tribunal, which would be efficiently managing and related to real estate, which would be worth as well as legislation as and when required. Now we would be talking about the state-specific features of RERA 2016. So till now, 15 states and union territories have actually notified their rules for RERA 2016, which includes 9 states and 6 union territories. Now, if we talk about union territories, the rules notified by the union territories are in line with the central RERA rules, because the central government administers most of the union territories. When it comes to state, each state has notified relaxation for developers on certain counts, which we will be discussing briefly. Next slide. Now, if we talk about few states, namely Bihar and Odisha, so these states have more or less kept their rules in line with the central ministry's regulation. And all, like I said, all the union territories have made their rules in line with the regulations as stipulated by the central ministry. Now, we discussed the framework. So each state and unit territory will have to form their own regulatory authority, and they will have to notify their own operational rules and regulation, which would govern RERA 2016 in that particular state. Now, this had to be done before May 1st, 2017, but like we discussed, only 9 states and 6 union territories have done with it. There is no deadline which has been mentioned till now, but what we expect is that most of the states will be coming out with their respective, they will be notifying the respective rules and regulations by 31st of July 2017. Now, these state regulators would be responsible for registering each real estate project and real estate agent. Now, even real estate agents are covered under RERA, which would see more transparency, because till now there was nobody or no law which was governing real estate agents. So this is another more transparent and accountable kind of law which is being pushed in, and this would for sure help in improving the buyer confidence. Now, the other most important part in the transparency and accounting, so this would be specific to a state, where the state would be maintaining a website dedicated to RERA, and this would be providing detail of each and every registered project, each and every registered developer, and each and every registered agent. So what this would ensure is that at click of a button, a buyer or a financial institution which is looking forward to actually check the credentials of a developer or a project could actually check on what has been the progress, how have they been doing, if they have any legal implications, or has there been any kind of cases pending against these. So there would be very high transparency coming into the sector. So moving on to the next slide. So we would be talking about 3 focus markets here. Karnataka has been the last state till now to actually notify the rules and regulations for RERA 2016. Apart from that, 2 focus markets in India would be Mumbai and New Delhi. So Mumbai comes under the Maharashtra Regulatory Authority, and I would say that Maharashtra has been one of the front runners in terms of implementation of RERA 2016. They actually notified the rules pretty much far back from May 1st, 2017. And the only difference has been they have relaxed rules for developers in the sense that they are expecting GST to kick in this year. So they don't want the sector to be actually have any adverse effect, because even they would have been looking forward to tax collection. So they want the sector as well as the buyers to be balanced. They have to balance between the buyers and the sector. So there have been few relaxations which has been mainly regarding ongoing projects, and some relaxations have been in the sense that in Maharashtra state in particular, before registration of a project, the approved for a project. So Maharashtra has provided a relaxation in terms that instead of approved, they can even submit a project where the plan is proposed. So it is not basically approved, but just proposed by the developer. Now, some buyers or some consumers would have a grievance toward this, but we think that going forward, the states would more or less iron it out. The state has provided some minor relaxation in terms of diverse, more or less, developers, where OC certificates have been already provided by the. Now, lastly, calculation of receivables in Maharashtra have been in terms of circle rates instead of the market rate. Now, how that pans out is that the 70% which had to be kept in a separate account. So the calculations in most cases, the circle rates would be lower. So that is, I would say, a slight relaxation for the developer, which would make it easy for the developer to maintain the account for whatever project. Apart from that, I think Maharashtra has kept the legislation in line with the central government. And the most of the relaxations provided are short term, because once the ongoing projects back. Talking about Delhi market in totality would have 3 states, because it also include in NCR we would include Gurgaon and Faridabad from Haryana, and Ghaziabad and Noida markets from Uttar Pradesh. So it more or less includes notification of regulations by 3 states, but we have been focusing on Delhi as a entity. So Delhi being a union territory, it is as notified by the central government. We have seen no major changes except a relaxation to details of court cases. So RERA in the Central Act says that all the court cases have to be provided, but Delhi has provided a relaxation of court cases pertaining to the last 5 years. So finally, moving on to the next slide. Mayor's view on states framing regulations. We feel that few states have, namely Bihar and Odisha, have been in line along with the union territories with the central ministries' regulation. Apart from the few rules and in terms of definition of ongoing projects and relaxation for registration of certain real estate projects, letting builders divest stakes is more or less to keep it balanced for the developers, keeping in view the GST which would be implemented. So states don't want the sector as well as their own tax collection to be hit during this year. So these are mainly short-term measures by the states in framing of regulation, and going forward this would more or less be ironed out. What we expect from the states is relaxation in the salient features which we think actually empowers buyers because of RERA 2016. So this would be mainly related to paying of penalties or lack of clarity in maintenance of separate accounts, even clause for structural defects. So any deviation on any of these salient features, we think that state need to address these immediately, because these are important and these are the main vital parts of RERA 2016. We have gone through legislations notified by few states, and I would namely say that Haryana, Madhya Pradesh, Uttar Pradesh, Gujarat and Kerala need to further align with the central government. So back to Jasmeen. Thank you, Jasmeen.
Thanks, Ashish. Um, we will now be talking about the impact of RERA 2016, the impact from the point of view of funding agencies, lenders, investors, and rating agencies. Now, what does RERA mean for developers? Now, developers will have to undergo a lot of operational transformation in the way that they do their businesses. They will have to do better cash flow planning. And yes, a lot of their bandwidth is going to get consumed in the existing projects, making them compliant. As far as operational transformation is concerned, the developers will have to do a business remodeling to suit the requirements of RERA. Their project planning and management will have to be significantly upgraded to meet the standards of RERA. This is obviously going to entail a lot of costs. As far as cash flow planning is concerned, this is very important as far as the financial stakeholders are concerned. Now, because all cash flows are not going to be freely available for use by the developer, so an efficient use of funds so as to comply with the project completion timelines as well as to maintain its debt servicing track record and its other corporate overheads as well as land acquisition, all of that will have to be thoroughly planned by the developer. Which means that they will have to do a lot of planning, maintain MISs to see what the planned cash flows versus the actual cash flows are, and make a suitable projection as to what really are going to be the available cash flows to them. The utilization of funds will have to be prudent as liabilities are very high for non-compliance. The existing projects under RERA will also require systems and bandwidth for compliance. Now, there is a 70% rule applicability, which Ashish has already talked about. Now, the existing projects will also come under RERA, and a lot of these projects are may already be in default. I mean, so to say that, a large part of their receivables may have already been withdrawn from the system. So it is possible that all the future receivables of the existing projects will now have to be maintained in the project accounts. A lot of times the developers used to rely on uh, new launches and getting the cash flows of those launches and utilizing it for existing projects, whereas the cash flow today of the existing projects were actually going into other uses of the developer. Well, that now is not going to be a possibility. For the developers, the intermingling of project funds therefore is going to be very difficult. There is going to be lower funds available for land acquisition, which may lead to increased requirements to resort to other sources of capital. Maybe we will see a change in the industry wherein the acquisition of land and formation of the land banks that the developers typically relied on in the past may decrease, and there may be a change in the model in which the developers operate to a joint development or an asset light model. Um, so therefore lower funds are going to be available for land acquisition. Uh, the developers with the corporate debt that were being serviced from project cash flows is now going to be more difficult. With the project cash flows not being available to a large extent for corporate use, the servicing of the corporate debt will have to be seen by the rating agencies in particular. Now we had actually seen that many developers resorted to corporate debt instead of project specific debt. But now since project cash flows are not available, so how the servicing is going to happen will have to be seen by us. And going forward, we feel that the bigger developers, the more organized developers, and the ones that have better access to capital markets with deeper pockets, they are the ones that would maybe emerge out of this situation. The launches are going to be low, the new launches, and maybe a little more spaced out. Now, significant preparedness is required before the launch of projects. The launches will also be spaced out for one more reason, that the developers now will undertake only so many projects as they can deliver on time as per their bandwidth permits. So as opposed to the earlier times when we saw a lot of projects which were going on, now they are going to be only so many which the developer can reasonably complete on time as promised. So we feel that maybe the small and marginal developers may not be able to cope up with the increased requirements of RERA. So this is how we feel the developers are going to get impacted as a result of the act. Now, what it means for the buyers. It's a huge boost in consumer confidence, definitely. The buyers have many positives for them as far as the act is concerned. Number one and most crucial is the timely completion of projects, which has been a problem. The buyers they pay in and they get invested in a particular project, and which if gets delayed leads to a lot of additional cost to the buyer in terms of the holding cost, which has to be only borne by the buyers, and all the penalties which are there typically in a agreement to sale. It never really happens, and we've at least not seen developers paying up for any delays. So at least now the buyers, they know what they are signing up for and what they are paying up for, and whatever customer advances that they pay, they lie in a separate account, and they know that it would be used for project completion, which definitely is a big consumer booster, a confidence booster for the customers. Other things which are important are the sales are on a carpet area basis versus a super basis. So that gives a lot more clarity to the buyer, because it was always difficult to determine what super built up area really meant. And there is greater information regarding the developer, its past track record, its history, all litigations against it, and a lot more details which the buyer can access before signing up for a project of a particular developer. Then there is project information which is available. There are regular updates, quarterly or 6 monthly, as per the specific state-specific RERA, are all available to be seen by the buyer, which is a great thing, because so far it was the buyers didn't really know where the project was headed and was it really getting completed on time. They were completely at the mercy of the developer. Then there is a defect liability period of 5 years for construction defects, which means that the quality of the construction is going to be as promised, and if any technical structural issues that come up at a later stage up to 5 years of OC, they will be rectified by the developer for no additional costs. Then there is a model builder buyer agreement which reduces a lot of ambiguity. There's also a registration of builder buyer agreement before before the developer receives more than 10% of customer advances. And there's faster dispute resolution mechanism through dispute settlement forums and appellate tribunals. So the infrastructure around the sector is also going to be robust so as to ensure strict compliance of the act. And there's going to be regulation of brokers as well. So moving on to the credit perspective, from lenders, what it means for the lenders, what it means for the investors and credit rating agencies. Now there are audited figures available every 6 monthly for project specific sources and uses of funds. This is a huge positive because credit ratings for real estate is based on cash flow approach. So anyway, this data was being used by rating agencies on an unaudited basis. This was sourced from the clients. Now there is going to be a whole lot of transparency around project specific cash flows, and this is regularly available on an audited basis. Audited figures give a lot more credibility to rating agencies as well as funding agencies. And earlier, when ratings factored in the risk related to the opaqueness in the sector, we expect should get improved a little bit. The separate project accounts will ensure liquidity in projects with good sales momentum. Now, if a project has a good location with decent sales traction, the liquidity of that project is likely to be much better, and it largely addresses the issue of diversion of funds into illiquid sources that have conventionally strained the liquidity in the sector. The cash flow analysis for real estate companies will have to factor in the available cash flows for debt servicing. While the lenders and rating agencies and the investors, they did a cash flow analysis of the company as a whole, where the cash inflows and outflows were seen, and then in terms of the debt servicing, how much coverage is there for the repayments is available was seen, and it basically pulled in all the inflows of the corporate and taking into account all the projects as well as newly launched projects. So that will have to undergo a little bit of a change because the available cash flows for debt servicing will now have to be seen. I mean, if we look at it, in the last 2-3 years, when the demand has been slow in the market, we have seen that the inflows have just about covered the uses of funds, and the debt servicing ratios have been quite moderate, very just above 1. So when a significant chunk of the cash flows now are not going to be available from the existing projects, then that means we will have to see how the developers will tide over this situation. So, I mean, if you look at it, the act is really more buyer-centric, and it's delivering of promises in a timely manner. So that is actually the construct of the act, that it is for protecting the interest of the buyers. So as far as debt servicing is concerned, as far as how the lender's interest or is protected and all, that is that's a we can say is a byproduct. So the cash flow management will be a very important function for every corporate, and that really will be the differentiator as far as the credit risk perception is concerned. So the developers which are better able to manage their cash flows around the requirements of the act and maintain high standards of debt servicing will definitely stand out in terms of the risk perception of the developers. Projects with reasonable sales momentum are less likely to be delayed. Obviously, projects can be launched only after registration, after the approvals are in place, and if there is good sales momentum in projects, then there is low funding risk. Uh, Such projects, so therefore, projects that can have this kind of a sales momentum, so location is good, and let's say their pricing and is good, then such projects from a lender's point of view will get easy funding. I mean, it should be comparatively easier for funding such projects, and also at more competitive rates. So if the lenders have a safeguard regarding their servicing, because now they know that the project funds cannot be diverted away to a large extent. So such projects will definitely attract funding from multiple sources and at better costs, is what we feel. Now, the registration requirements and approvals will stop the practice of pre-launches, and even the new launches are going to be more spaced out. We talked about it, but from a credit perspective, how it matters is that this metric was earlier being used to determine future revenue visibility and to ascertain the liquidity. So if a developer has a good land bank available, and we know that it's come to a stage with all relevant approvals, so as to go in for a soft launch, or the developer can launch, then that was taken as a metric for a flexibility at the hands of the developer to garner cash flows in the future. But even if that happens today, it maybe the cash flows will not be available. Moving on to the next slide, this is an important point which I've already touched upon also, that the developers that have large corporate loans in their overall debt profile may have to find sources for repayment of these loans. So such developers will have to be we'll have to see them more closely, that how they will manage the situation. The market actually may also turn in progress into in a way that maybe now corporate loans are going to be available not so easily to developers, because the sources of that, or how the repayments of such loans will happen, will have to be determined. Many developers created large land banks, amassed large land and have liabilities in place with this land not entirely being paid for. Such developers again will now need to ensure or arrange for capital in order to meet their land liabilities on time. Quarterly reviews now can be more comprehensive. This is a positive for from a credit rating agency perspective, and again for the lenders, from the lenders perspective. They can be easily, we can see how the project is progressing, both from a financial progress point of view as well as from a physical progress point of view. The reviews can become easier because the information is available on the website. Even the sales momentum and the cash flows that are available, because the sources and uses of funds are there, audited numbers there too. So this will make it a lot more easier for the lenders to keep track of their investments, and even for rating agencies to keep track of their the rating movements. There are severe penalties, including cancellation of registration. Name of the promoter will feature in the list of defaulters, and photographs will come on the website, and all other state RERAs will get intimated. So these are the kind of deterrents which are there in the form of penalties for developers if they don't adhere to the requirements of RERA. And these will be an important kind of a track record check for the funding agencies. So for any new lender to enter into a financing with a developer, there will be a track record which will be available in an organized way, and both the track record of the developer, its operational as well as its debt payment track record will be available. So anyway, I mean, the rating agencies relied on publicly available data for this, but now this is going to be available in a better organized way. So that is going to be also very helpful for the lenders as well as for buyers. In the next slide, we are talking about the liability of the developers, which will now have to be factored in the credit analysis. So there is, like we discussed, a defect liability of 5 years, where the developer will have to incur costs for making good any such structural defects without incurring additional costs. So these will increase the liability of the developers going forward. And there can be penalties also, which can go up to 10% of the project cost or imprisonment. So these are certain costs that may come on the developer, and therefore will have to be factored in as a contingent liability by the lending agencies as well as rating agencies. So finally, to summarize, what is the sector impact? Uh, Definitely a lot of positives, and probably more positives than negatives. The act restores confidence of buyers over the long term, and maybe this will help revive demand. Plus, market will also probably move towards a more end user driven market, which already is there right now, but this would restore consumer confidence to a large extent. Uh, the act also strengthens the confidence of investors and funding agencies because of the transparency and quarterly updates, timely delivery, liquidity through project accounts, etc., which ultimately should lead to flow of funds into the sector, and should lead to better rates than what we have seen in the past in this sector. Uh, Same point, we may help revive sales and reducing costs. Then another point is about accepting customer advances greater than 10% will require a registered agreement to sale. So to some extent, this will increase the cost of the buyer, and so we may expect the end user market only, the end user buyer will be interested here. So the investor market should be cut to some extent. And the sector should see probably asset light model of development rather than creation of land bank, because that would require deeper pockets of developers. The negatives are that the launches are going to be slow, at least for some time. We will see that, because a lot of bandwidth of the developers is going to get consumed in complying right now, and to see how the existing projects will comply, and therefore new launches will suffer. There will be increase in prices to the extent the costs increase for developers. There is definitely going to be a transfer of risk from the consumer to the developer in terms of the project delays, etc. So that cost will increase for the developer. So these would be some of the negatives. What more? Approval delays, which are completely outside the control of the developer. Uh, because of that, if project progress is impacted, that really is an outside factor, but the developer will have to will get penalized, and that probably will remain a bone of contention going forward. Maybe we will see a single window clearance mechanism for approvals. Let's see if that happens. The issue of black money, which is there in real estate transactions, I mean, the act does not address that, but there are other policy measures which are there by the government to reduce the use of black money. Most importantly, when I will wrap up with that thought in mind, is that the implementation of RERA on the ground and how it gets executed by each state and that the spirit of RERA should be executed rather than just it remains an act and just does not get executed in a proper manner. That will then defeat the whole purpose. So the implementation is really the key, and only time will tell, as we progress, we will see how this really pans out, and the impact will therefore become more clear at that time. So thank you. This is all we have, and over to you again, Dinesh.
Thank you, Jasmine. Uh, Dear participants, we would now be taking a break of 2 minutes. Before we come back to take your queries, you are requested to start keying in your questions. We look forward to receive your questions. Thank you. Yeah, now we have a questions. Jasmine, there is a question from one of the participant. Question is, are you looking at a scenario where net cost to the buyer will increase as a result of builders passing on all their compliance cost to the end user? Yeah, Jasmine.
Yes, thank you. So the costs of the developer will increase, yes. Uh, some of the reasons why these costs will increase, number one, there will be restriction on the use of cash flows by the developers. So that is one reason. There is increased cost of compliance such as web page maintenance, monthly updation, quarterly filings, etc. Also the risk on account of delays, quality, title, and etc., which earlier was borne by the customer is now transferred to the developer. As a result, the cost to the developer definitely increases, and to some extent it is going to get passed on to the consumer. Well, we'll see whether all costs get passed on to the consumer. It's probably a function of demand and supply. But yes, costs will increase. To that extent, prices should increase a little bit.
Yeah. So we'll take the second questions. Basically, out of the sales receivable, 70% will have to be parked in escrow and has to be used for construction cost only, right? So far?
Um, Well, this question is that whether the 70% will be parked in an escrow and all of that will be used for construction cost only. So first of all, there is not an escrow account which is going to be created. Initially, the real estate bill talked about creation of an escrow, but in the act, there is a creation of a separate account, not an escrow account. So it's not an escrow, and 70% will have to be parked. Yes, all of this is going to be for the project. And now as the project progresses, there is a based on the percentage completion method. So as the percentage of cost incurred on the project, to that extent the funds will be released to the developer, which can be used for project specific purposes. According to us, it is for construction as well as for the debt repayment that is taken for the project.
Okay, the next question is that would RERA implementations help developer attract more FDI?
In terms of attracting more FDI or in terms of getting more funding into the sector, yes, there is going to be an increase in investors' confidence. That is definitely an expected outcome of RERA implementation, and there is a large pool of funds waiting to be invested in the real estate sector in India. Traditionally, the issue of lack of transparency and the unorganized nature of the sector, and that there was no regulator in place, led to lower inflow of funds. But I maintain that an effective implementation of RERA is a key now, and if that happens, one of the desired outcomes is definitely going to be an increased inflow of foreign funds, provided there is the act gets implemented in its right spirit.
Now, there's another question, and ongoing projects, if the cash flow is already diverted by the developer, how that is going to be addressed? Devraj asking this question. Over to Jasmine.
Yes, thanks, Devraj. So ongoing projects, if the cash flow is already diverted by the developer, well, if that is the case, then I also touched upon that in the presentation, that all the remaining cash flows of that project is then going to be in the project account only. So then no further inflows from that project will get released. So, I mean, in terms of the 30% which was otherwise available to the builder for corporate purposes, that is not going to be available in these projects where funds are already diverted. Now, another way of looking at it is that what about even maintaining that 70%? I think that is what you are trying to ask. That even maintaining that 70%. Well, there is no clarity right now on what will happen in such a case. Then maybe additional funds will have to be brought in by the developer, because because for the completion of the projects as per the timelines, that will become important.
This answer to the same question.
There is another question, how RERA is going to take care of ongoing projects where developers have already collected significant money from buyers before. So it's the same question. In the existing projects, I mean, this is a question which is repeatedly being asked. So there's another point which I would like to touch upon. In terms of the existing projects, if they are already delayed beyond their initial agreed timelines, what ERA says is that the developers now will have to register those projects and will have to give a timeline now. So obviously the timeline that will be given now is going to be at a later date. So there is some amount of confusion here that if this happens, then the buyers who are already stakeholders in that project, what will happen to how will the implication to them is really uncertain, because will they really agree to a timeline which is further than what was agreed to them at the time they entered the purchase, and will they demand a suitable compensation, and will the regulator have to permit that, is something that we will see as time progresses. 5 minutes. We can maybe take a couple of more questions because we still have 5 minutes remaining.
There's another question. How do you see RERA affecting demand supply across markets in terms of new launches and primary sales? This is a question from Mr. Vijay Garg.
Thanks, Vijay. So your question is that how do we see RERA affecting demand supply across markets, and in terms of the new launches and primary sales? Some bit of this I covered in the presentation. The new launches are expected to slow down. The projects have to be RERA compliant before they are launched. So in terms of the supply side is concerned, the new launches will slow down. And that is because of one, the compliances have to be there in terms of approvals, and secondly, in terms of the management bandwidth not being available for new launches. So the supply side will get impacted. From the demand side, well, the demand and supply, demand is market driven, and policies are just enablers. RERA is definitely expected to lead to restoring of consumer confidence as well as investor confidence. So in terms of that itself, we feel is a boost in the consumer sentiment, which should be a positive push to demand. Another thing over here will be that because now the launches are going to be spaced out, so the appetite for the existing inventories will go up, and we may see that the inventory levels which are currently there may come down, because while the demand should get restored, but on the other hand, with new launches not coming in and so fresh inventory not getting piled in, so maybe there an outcome could be that the existing inventories should go down, so which should create some kind of a demand supply balance. So one question is that the defect liability of 5 years would commence from the date of handover of property or date of completion of the project. This is asked by Akhil. So Akhil, see, this I think is from the date the occupation certificate is there. So from the date the developer offers possession of the property, from then on the 5 years will start, and it is going to be common for all the buyers. It cannot be that as and when buyers come in for possession, the timeline for them will be different. So it's going to be one single timeline. Another question is, what do you see impact of RERA on the inventory that has piled up in Noida, Greater Noida, Ghaziabad or Delhi NCR. Okay, I've just addressed that maybe the inventory levels may see some correction, but I think for that to happen, I mean, really, the buyer sentiment has to go up substantially. So we need to see a significant increase in demand levels for inventory levels to get corrected. But one impact is that that now with new launches not coming in, the existing inventories will get consumed.
Okay, so we are actually taking a last question. How do you think this RERA going to help in debt financing and refinancing of real estate projects? Over to Jasmeen.
Okay, so how RERA will help debt financing in the projects? So the objective of the act is customer protection and penalizing errant builders. Funding in the sector is not really an objective, but the act comes as a boon for banks and lenders. Uh, as we have covered during the presentation, the projects where there is a good amount of sales, uh, definitely those projects will see a good funding from lenders. An important aspect is that monitoring of loans given to builders is now going to be easier. Now we are headed towards a better governed sector with transparency and fair practices, and this is likely to lead to higher funding. And it's also possible that the cost of funds may reduce as we go along. I mean, what we have seen traditionally is that the IRRs have gone up to 25 to 30% in real estate funding. Maybe as we go along, there is some moderation in these kind of unheard of rates. So.
Thanks again to all the participants for taking the time out and being a part of this care rating seminar, ratings webinar. We hope the discussion was insightful and look forward to your participation in future also. For any further queries or feedback, please write to us at corp.com, which is short form of corporate communication. I'll spell it out for you. corp.com at the rate of careratings.com. Goodbye for now. Thank you.